Hi, I'm Nash Anderson with Alpha Crusaders. I'm here to give a general overview of high cash value whole life insurance, or what is commonly known out there from various marketing as the infinite banking concept, bank on yourself. Basically, a very unique way to utilize whole life insurance. Whole life insurance has a really bad rap, but I am an engineer by training, really like to get into the numbers, see how you can use things that isn't the traditional path. Definitely not the Dave Ramsey way that he's talking about and bashing whole life insurance. And so this video is to get into the numbers. So I'm going to go over it briefly and then dive right in to kind of show what we're talking about. So why is high cash value whole life used, or otherwise called the infinite banking concept, used by the wealthy, banks, and corporations? And the primary reason is cash value and growth of that cash value over time can be a very strong asset. And as you can see, I get quite excited talking about this because a lot of people don't know about this way to utilize whole life insurance. These policies offer a safe, liquid, and tax-free area to position your money. Safe meaning, depending on your state, there is some creditor protection, but more so, it's a stable and steady return. We use what's called mutual companies. There's also stock companies, which are, based on stockholders and, have motive to deliver returns for stockholders of the company. Mutual companies, when you buy a policy, you become part owner in that company, and so there's no double motive there. They've been around for 160 years, and they have paid what are called non-guaranteed dividends in addition to their guaranteed interest rates consistently, even through Great Depressions, recessions, pandemics, etc. It's very boring, but it's the slow and steady 3 to 5%, sometimes back in, the 80s was, up to 6 more percent, but 3 to 5% now day and age of those consistent compounding returns. Liquid, because it builds immediate cash value. You can get anywhere from 80 to 92%, depending upon the product and the design, of money contributed back into cash value in year one. And then break even, meaning having access to cash value of the amount you've contributed anywhere between years 4 and 6 with these designs, depending on the product, your age, your health rating. Depending on what your goals are, we can slide those around. So lots of liquidity, and then from there it starts to grow. I'm just talking about year 1 through break even, and then it starts to grow from there and becomes a very slow but continuous asset that continues to compound for you, and tax-free. If used appropriately, there are no tax consequences for accessing your cash value and your death benefit. So your death benefit is paid income tax-free. It will not avoid estate tax if you're over the estate tax threshold, currently very high in the 20+ million for a married couple. That those change from time to time, but will be paid income tax-free, which is really nice. And in later videos, we can go into kind of how that works, because you definitely want to use it appropriately. So I promised I wouldn't dwell too much on the overview. Let's dive into the numbers. So I have here what's called a complete life insurance design. Your traditional life insurance, you might find this from any broker that is out there, insurance company, and then a infinite banking design. So a base policy design, what I mean by that, I'm going to jump down here to kind of show what's going on. We're looking at one of the major mutual companies that's out there, what we're showing, this could be any amount, but $100,000 going into buying you whole life insurance. So whole life death benefit. So $100,000 per year in annual premium, buying you about $5 million in death benefit. So what I've done here is design this to have $100,000 going out for 7 years, $0 thereafter, and you can see that it's buying you 5 million, and it's starting to grow a little bit. And then because whole life insurance, they take your premiums and amortize it over a certain amount of time. This one is till age 95. You can elect not to do that and go for a shorter time period. I chose to show this stopping after year 8. So how much does $700,000 total out of pocket actually buy you? And that 5 million assumes that you're actually paying until you're age 95. This is based on a 40-year-old male, and this comes back down to $1.6 million. You have a cash value of $627,000 at that time, and you get over that $7,000 hurdle in terms of access by year 11, and it starts to grow from there. In year 1, you put in $100,000, you have $3,544 to show for it. That's not that attractive. Year 2, you plop in $100,000, you have more to show for it. Total $200,000 has gone in, $106 out. Let's look at the infinite banking design, or the high cash value design. It is the same 40-year-old male, but we're now putting in this isn't exactly the minimum, but to make the numbers kind of easier to work with in our heads, $10,000 into the base premium, buying us whole life insurance, and the other basically $90,000 going into paid up additions, or what's basically a cash dump in. So minimum, you can go a little bit lower than this, but minimum whole life base premium, maximize the amount going into paid up additions. So what does this look like? It's total $100,000 out of pocket, but that $10,000 is going to actually whole life. And voila, what do you have? Instead of $3,000 measly dollars in cash value, you have $82,848 coming back and that you have access to. The death benefit is definitely lower. You're paying less out of pocket, but hold on, let's wait and see what happens over time. So let's look here. 100 in, 82,848 in year 1, 100 in year 2. Wait a minute, you almost have exactly what you put in. 82 plus 100 is 182. We have 181,346. By year 3, another 100 in. 181 plus 100 is 281. We now have more than that, 282,703, and it starts to grow from there. Year 4, we put another 100 in. 282 plus 100 is 382, but voila, we have 388. By year 5 in this design, we've put in 500,000. We've caught up. We are overcharged in year 1 for basically whole life insurance, death benefit. But by year 5, we've made up that difference and we have put 500 in. We have 500 back out in cash value that we have access to. And then it continues to grow every year thereafter. So I'm going to put these two side by side. I don't like to look at the PDFs. I just took these numbers, put them right into Excel so we can view these numbers. This is that same all base premium design, $100,000 going straight into buying us whole life insurance on the left, and the high cash value design, which is essentially 10%. You can actually get it a little less, as I keep mentioning, but 10% buying us base premium, maximum amount going into buy us cash value, or going into the cash value component on the right. So again, 100 in, what did we say? 335.54 in net cash value in year 1. It's a 96.5% hit on your money, 4% coming back to cash value in year 1. That's terrible. On the right, 100,000 going in, still a hefty hit. Nobody wants to see this. 17% being charged for life insurance, or the opposite of that is 83% coming back to cash value. I was talking about how you can get it, higher or lower depending on the product and the design, but this is very typical, just flat design. So And in year 2, minus 0.8%. So remember, it was slightly lower than that 100,000 coming back into cash value. Break even in year 5, and then starting to grow and compound from there. We're not putting any money in after year 8 into either of these policies. And so let's scroll down here. This was a 40-year-old male. So at age 60, what do we have? Let me freeze these real quick. All right. So we got our column headers here. All right, age 60. Cash value on the full base premium design, 1.147 million in cash value. What do we have in the IBC design? 1.419 million in cash value, and we had access to it much sooner to put it back to work if we want. Death benefit. Remember, on the all base premium design, we were buying a lot of death benefit. Well, why do we have less? 2.126 million in death benefit. On the left, even more death benefit with the IBC design at 2.628 million. So drastically different. A unique way to use these is that high cash value design gets you a lot of access in years 1, as well as the further down in the policy. What I have here in column X is actually the year-over-year growth. So once we stop funding in year 8, year over year, the policy cash value is actually growing by $35,000. And at age 60, it's growing year over year at $63,000. So, very slow and steady growth over time, but providing a very nice, consistent return, alternative asset, place to store liquidity and cash that you can have access to. This cash value, with Guardian, you can go in, request a policy loan, get your money within a few days. That's a whole nother topic, but brushing onto this at the very surface, this is why it's a very attractive product to position liquidity for, wealthy people, banks, corporations use it heavily, real estate investors to store money while they're waiting for their next opportunity. But it is not exclusive to these people. This is a $100,000 design. Really, it can scale up to millions of dollars put in a year. It can scale down to 50,000, 10,000, 1,000, it doesn't matter. It's all about the design, minimizing those whole life insurance and maximizing that cash value component, and it would deliver the same results, just at a different scale. Lastly, over here, I just wanted to show this is that difference from that whole base premium design to the high cash value design. I just wanted to bring it home here, that difference in cash value, that difference in death benefit. So the green means that the high cash value or IBC design is this much more than the all base premium design. The difference in death benefit, if it is red, it means that the base premium design is better, and the green means the IBC is better. So if we're just zooming in here a little bit, cash value is clearly king from day 1 all the way down throughout the life of the policy. Age 70, $400,000 more in cash value in the high cash value design. The difference in death benefit, it is actually less until that option where in this design I elected to stop paying $100,000 every single year, but from the age you open it until age 95 for this particular product, that's a lot of money. Buying a whole lot of death benefit, they basically amortize that cost over your life to buy that death benefit. So that's why it's higher in the base premium design. And then once we elect to stop paying, the high cash value design actually is much greater and continues to compound, and that compounding in the policy adds to cash value as well as death benefit and outpaces the traditional design over time. So really great design that a lot of people do not know about. This is definitely brushing the surface on it, but providing, what this can offer at a very high level. I just wanted to add a little bit more here. So what else? So like I said, it can be $10,000, it can be $50,000, it can be target $100,000, $350,000. It does not matter as long as the design is right. That is key. Liquidity. You want to make sure we're putting 10% base premium or less, basically the minimum amount, really going into expenses or fees buying the life insurance, and the maximum amount into paid up additions or cash value right away. That money in there begins to compound, buying you more death benefit, buying you more cash value every year, and that's why it outpaces the heavy base premium design. You can park safe money in here. It is essentially, you can think of it as a bond alternative. Bonds are kind of boring and not returning very well, but in the past, they have been the very safe, steady returner year over year. These companies do invest the money that we're giving to them. You used to invest heavily in bonds. Now they're looking, because bonds aren't as attractive, more into very nice, high cash flowing real estate, cash flowing businesses, that sort of thing. But they have to have very, very high credit ratings so that they can maintain their very high scores from a financial standpoint. And they've done very, very well. Payment flexibility. You can bounce your payments up and down. So really the minimum needed to ensure the policy survives is that 10% going into base premium in the high cash value design. Where in the other design, if you miss your $100,000 premium payment going to those base dollars, your policy isn't going to do very well, and it could actually be at risk of lapse. But in the IBC design, that 10% base premium is, you want to make sure you can cover that. That additional 90% is flexible. You can pay up to, so $10,000 was our base. 90,000 is flexible up into that PUA. You can fund 90,000. You could fund 80,000. You could fund 1,000. Whatever. We like to use Guardian amongst other major companies because they provide lots of flexibility. You can pay into it as you have the money, as deals are paying you distributions, whatever, to fund your policy. You can actually miss funding and roll it over and catch up. So very flexible when designed this way. The tax benefits. So this is post-tax dollars going into the policy, but it grows tax deferred. You can access it tax-free, so it's tax deferred indefinitely as long as you access it appropriately, and the death benefit is paid income tax-free. Again, we can't escape the estate tax threshold if we're over that estate tax limit, which is very high for the very high net worth clients. But life insurance is also used to help make sure if your estate is over that estate tax threshold, life insurance helps cover that so that your estate is not taking too much of a haircut when passing to your beneficiaries or your heirs. Real estate business owners like to use this quite a lot because it's a safe, liquid, tax-free area to position your money while waiting, and you have access to it when you have a deal or if you need it for your business. And it's still growing more than just plopping it in a checking account, earning 0.1% or whatever. It's earning a better return than that and has additional benefits that come along with it. And I already covered legacy planning. So that death benefit certainly does grow over time. We talked about the tax portion, but certainly passing along money to your beneficiaries or your heirs or your trust is even though we're minimizing that death benefit kind of because we see it as an expense over the short term, it certainly grows quite a bit over time and will pass along to provide a substantial amount to your beneficiaries over time. All right, I hope this was helpful. Definitely just brushing the surface. I'm starting a YouTube channel to go down into many of the topics that we talked about here today. Feel free to reach out if you have any specific questions or want to see some of these policies, and we can talk about it in more detail. I would love to talk to you about it. All right, thanks for now.